Stop what you're doing and listen carefully. Today is April 21st, 2026. Just 32 minutes ago, the Shanghai Futures Exchange issued an official notice: an emergency suspension of all silver futures trading, effective immediately when markets open on morning, April 22nd. This is not a rumor. This is not speculation. This is an official announcement from the largest physical silver trading exchange in the world. And what just happened could mark a turning point for the global silver market. Right now, silver is trading around $75.80 in New York. But the last recorded trade in Shanghai before the halt hit 643 yuan per kilogram, which converts to roughly $91.78 per ounce. That's a $16 spread versus COMEX, a massive price gap, and potentially the largest single-session divergence in modern silver market history. But here's where it escalates. Shanghai, which handles roughly 40% of global physical silver volume, is now shut down indefinitely, with no reopening date announced. In the next few minutes, I'm going to show you exactly why this happened, what it means for COMEX, and 3 specific actions you need to take within the next 12 hours before Western markets fully grasp what just detonated in Shanghai. Listen carefully, because what just happened on Shanghai Futures Exchange is not normal. Official notice SHFE 226047 says silver futures trading is suspended due to abnormal market conditions and the need to protect participants from extreme volatility. That's the polite version. The real message? They lost control and shut it down before it got worse. This wasn't a market-wide issue. Not copper, not aluminum, not zinc, just silver. And this isn't a 5 to 15-minute circuit breaker. This is an indefinite halt, reopening only when regulators believe stability can be restored. Translation: Shanghai will not reopen silver until they figure out how to stop what just happened from happening again. And what happened? Physical demand overwhelmed supply to the point where price discovery broke. The numbers don't lie. April 14th, 467,000 contracts traded. At 15 kilograms per contract, that's 240 million ounces in a single day, equal to 3.5 months of global mine supply. But volume wasn't the trigger. Delivery demand was. May contracts alone demanded 58.3 million ounces, the highest in SHFE history. Available inventory? 61.7 million ounces. That's 94.5% utilization. 5% away from empty. At that point, an exchange has only 2 choices, and neither is pretty. Here's the moment that matters. An exchange only has 2 choices: let price explode until demand collapses, or shut the market down. Shanghai Futures Exchange chose to shut it down. And that decision tells you everything about the real condition of the global physical silver market. Because this isn't volatility. This is structural stress. Proof number 1. The halt applies to every contract month. Not just May. Not just the front month. Everything. If this were a short-term delivery squeeze, they isolate the problem. They didn't. They froze the entire curve. That signals a system-wide shortage, not a temporary imbalance. Proof number 2. No new positions allowed. You can close what you have, but you cannot open new longs or shorts. Exchanges only do this when new buying could trigger a price move so violent they lose control. Translation: the real free market price of silver is already beyond what the system can handle. Proof number 3. Every participant must report physical inventory and delivery commitments within 48 hours. That's not routine. That's an audit under pressure. Because when an exchange starts asking who actually has the metal, it's already questioning whether the metal even exists. If you're hearing this before mainstream financial media catches up, that's exactly why you subscribe to Precious Metals Report. Because what's coming next doesn't wait. This starts tomorrow morning when Western markets open. China's industrial buyers, solar manufacturers, electronics firms, government stockpiles were relying on Shanghai Futures Exchange for physical silver delivery. Now that pipeline is frozen. So where do they go? 2 places: COMEX in New York and London Bullion Market Association in London. Here's the pressure point. COMEX has about 74.2 million ounces of registered silver. If just 20% of Shanghai's 58.3 million ounce delivery demand shifts, that's 11.66 million ounces of urgent buying. That's over 15% of available inventory, hitting in days, not weeks. And these aren't speculators. These are industrial buyers. They can't wait. COMEX now faces only two outcomes: a violent price spike to ration demand, or a delivery failure that forces the same kind of halt Shanghai just triggered. There is no middle ground. And here's what most people are missing. This isn't just about silver. When one major exchange shuts down, trust breaks everywhere. Capital moves fast. Even a 5% shift from Shanghai could send $12 billion into COMEX chasing just 74 million ounces. That's not a market adjustment. That's a system stress test. The math doesn't work anymore. Either price explodes, or the exchange follows Shanghai. Here's how tomorrow likely unfolds in New York. Silver opens around $76 to $78. At first, the reaction is muted. Most Western traders haven't fully processed what it means to lose nearly 40% of global silver trading capacity overnight. 8:30 a.m. Eastern jobless claims hit. If the number comes in higher, silver may dip briefly on recession fears. That dip? It's not weakness. It's the last window to buy before the Shanghai shock fully transmits. Between 9:00 and 10 a.m., institutional research starts circulating. The mechanics of the Shanghai Futures Exchange shutdown become clear. That's when real money moves. By 10 a.m., silver is already testing $78 to $79. Then comes the trigger. 2:00 p.m. Eastern COMEX inventory report. If registered stocks drop by even 2 million ounces, the connection is made instantly. Supply stress, delivery risk, system strain. Price breaks $80, closes between $81 and $84. A $5 to $8 move in a single session, not speculation. Repricing. Because when 40% of the system disappears overnight, price doesn't adjust slowly, it snaps. And with Silver Eagles already trading $9 above spot, the physical market is already telling you where this is going. Right now, the signal isn't coming from charts, it's coming from premiums. Silver maples are trading $7 over spot, generic rounds $6 over, and those premiums have held steady for 3 weeks. That stability ends tomorrow, because once Chinese industrial buyers cut off from Shanghai Futures Exchange, start sourcing from the West, supply gets redirected. Not to retail, to large commercial buyers. Dealers get drained, retail gets squeezed. Premiums don't drift higher, they spike. I wouldn't be surprised to see Eagles at $15 over spot, generics at plus 12, nearly double within 72 hours. And here's the key point. If you already hold physical silver, that's not a loss, that's a gain. Because your replacement cost just jumped. $80 spot plus a $15 premium means the real price to replace your ounce is $95. You paid yesterday's price? That spread? That's your margin of safety, and it just expanded. But if you're trying to buy after that spike, you're paying the new reality. And timing matters. Historically, exchange halts last at least 72 hours. The London Metal Exchange shut nickel for a full week in 2022 and reopened at much higher prices with strict limits. Expect the same here. When Shanghai reopens, it won't be the same market. What happens next changes the structure of the market. If Shanghai Futures Exchange is no longer a reliable price discovery engine, even after reopening, then global pricing power shifts to one place, COMEX. And that's a problem. COMEX is already stretched, registered inventory is tight, paper to physical leverage is sitting around 736:1. Now remove Shanghai, the pressure valve, and force that demand into an already stressed system. This isn't a gradual shift, it's a compression event. So here's what you do before New York opens. First, check dealer websites tonight. Look at premiums. Look at inventory, screenshot everything, because by tomorrow, those numbers won't exist anymore in the same form. Second, if you're planning to buy physical silver within the next 30 days, move that timeline forward, before 9 a.m. Eastern. Don't wait for confirmation. By the time price confirms, premiums have already moved. Your advantage right now is timing. Third, if you hold leveraged paper silver positions, understand this: tomorrow could be the most volatile session since January. Know your levels, know your margin requirements, know exactly where your broker forces liquidation. Because in this kind of market, you don't want to be reacting, you want to be positioned. This is John from Golden Exchange, April 21st, 2026. 32 minutes ago, Shanghai Futures Exchange pulled the plug indefinitely on all silver trading. Let that sink in. 40% of the world's physical silver capacity gone in a single move. And while that just happened, the spread between Shanghai's physical silver and COMEX paper silver didn't just widen, it accelerated. $12 became $16 in 3 weeks. That number. Tomorrow, the Western markets will finally understand what it means. But here's the problem: by the time Bloomberg runs the headline, the move may already be over. So you don't wait for confirmation. You prepare tonight. Because if this window gives you an edge, you take it before the system catches up. This is Golden Exchange. Stay locked in, we're tracking this hour by hour.